SJM is at a 52-week low, down 32% year to date, offering a yield of nearly 4%. This company looks undervalued. We're going to take a look today at in-depth detail of the company, whether it's one you should be buying for your portfolio. We'll look at the historical performance of the company. We'll look at their top line as well as their bottom line net income growth over the last few years. We'll look at how healthy this company is, total cash versus total debt, and we'll analyze their performance on a year to date as well as the last 5 years versus some well-known competitors. And we will look at their dividend safety and some important financial metrics you need to understand before buying this company in the packaged foods and meat industry. And as always, we'll analyze what are the institutions doing. Are they buying? Are they selling? And this will lead us nicely into our valuation model, getting to our intrinsic value and acceptable buy price given our margin of safety. Now, this company has been hammered massively, down 32% year to date, trading at its 52-week low with a very decent starting yield. Now, investors who would have been holding this company over the last 10 years would be up around 4%, very mediocre. We do see it hit an all-time high beginning of this year at around $163. But is this one where we can see the share price even double over the next few years and that yield on cost in double digits? Jumping straight on now, their income statement, top line revenue, we like to see 3 to 7% growth year on year. 7.8 billion in April 2019, 8.5 billion in April 23. So the top line has grown over the last 5 years. On a more granular level, we do see some very strong inconsistencies, relatively flat from 19 to 20. A very small increase to 2021, again fairly flat into 22 before another small increase into 23. So yes, it has increased their top line over the last few years, but it does look fairly inconsistent. Now, what story does the bottom line tell us? Well, 514 million income on the bottom line in 2019, a 91 million loss in 2023, and we can see why that share price has taken a hit. Now, if we look on a more granular level, we do in fact see the share price, or in fact the bottom line net income, increase to 2021 before decreasing in 22 and again in 23. So we can see they are struggling with that bottom line. Yes, their top line has increased, but their bottom line is struggling. Now, in terms of their balance sheet, total cash versus total debt, their cash position has gone up about 7 times from 100 million in 2019 to around 700 in their latest report. Now, comparing that to their balance sheet, in fact, their total debt numerically and directionally, 6 billion debt in 2019, and they have paid some of this off, around 4.5 billion in their latest quarterly report. So positive signs to see for this company. They are increasing their cash position whilst decreasing their total debt, and we'll analyze their dividend safety and net debt to EBITDA metrics shortly. Now, companies in a similar sector, we have Campbell Soup Company, which we have analysed recently on the channel, as well as a few others. Now, year to date, they are in fact down 30%, including those dividends reinvested, the worst performing in the industry. And when we look at the last 5 years, we see they are up around 21%. Again, one of the middle performers, but as always, past performance is never really an indicator for the future, so do just bear that in mind when you are analysing stocks. Now, institutions, well, there's around 79% institutional ownerships. 2.2 billion worth of these shares have been sold over the last 12 months, with around 3.53 bought in the same period. So overall, institutions are buying more shares than selling, and we see over the last 2 quarters, green depicting the inflows, red the outflows, that institutions have been buying more than selling. Q1, we see a slightly opposite story, whereas Q4 of 2024, a large buy of this company, no doubt when it was at a much higher share price. So as always, that is why I mentioned, do bear in mind what institutions do, but never base that as your final investment decision. And it is just one part of our investment analysis. Now, before we jump into the dividend safety and metrics, let's take a quick look at their earnings report. So their Q3 earnings report, July 23, they in fact beat on the earnings per share by around 17 cents, which was positive to see. However, they did miss their top line by 300 million. When we go back to Q2, they in fact beat on both earnings per share and top line. And when we go to Q1, they beat on the earnings per share, but came roughly flat in terms of their top line. So some mixed earnings. And when we look at their Q3 23 versus Q3 22, we do in fact see their top line coming in lower. So they brought in less sales this quarter than the comparative last year. but they did much better in terms of the bottom line, earnings per share, net profit margin, and operating margin. So again, there are some positives with this company, but there are some things that you just need to be aware of. Now, dividend safety score 80, it is safe. Market cap 11 billion, so it is a large cap company. Now, when we take a look at essentially some recessionary metrics, they did increase their dividend during the 07-09 recession. Fairly flat sales, but remember the average growth of companies in the S&P 500 was negative, and they did outperform the S&P as well, negative 27% versus the S&P's negative 55%. Now, when we take a look at the dividend growth, July 23, not bad, 3.9%. I always advocate a minimum realistically of 4% on the channel, as that means you're keeping in line with inflation. 6% over the last 5 years and 8% over the last 20 isn't too bad either, and you are locking in, as we did see, a starting yield of just under 4%. Now, they are effectively been paying dividends for the last 21 years, so around 3-4 years shy of becoming a dividend aristocrat. And dividend yield theory, well, it states a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, and we can see this is the highest yield the company has offered over the last 5 years. Likewise, forward PE well below the 5-year average of 14.5, so another sign of undervaluation. Alongside the consumer staples industry PE, significantly higher, 18.7. Now, yes, it is at the 52-week low, but do bear in mind, 52-week low is not a signal for undervaluation. Likewise, 52-week high isn't a signal for overvaluation. Now, earnings is susceptible to manipulation by management through accounting, so let's focus on free cash flow and below 60%. The reason for this is because it means management can offer those double-digit increases we love to see. It has been, in fact, below 60% consistently over the last 10 years, 22 and 23 coming right there at 60%, with 23 expected to be slightly lower, so we can see why that dividend for now is safe. Free cash flow per share, 553 in 2014. There's some nice growth to 2023 of 675, but we do see some years of incredible growth followed by decreases, so it is fairly inconsistent overall. Now, sales growth is important, as we do want to be keeping up at least in line with inflation in terms of the sales. Otherwise, in real terms, the top line is decreasing. Very, very inconsistent. In fact, quite a few years of flat growth and some years of single-digit negative growth. Now, numerically, this translates to around 5.6 billion of sales in 2014, 8.53 in 2023. So it has increased by around 50% over the last 10 years. Now, shares outstanding, we love it as investors when companies do share buybacks, returning excess cash to our pockets. But we do see 2015 to 16, they do the opposite, share issuances, which basically dilutes your position as a shareholder. But then they started again doing share buybacks. So overall, over the last 10 years, they have really just increased the shares outstanding by 2 million. So no real movement overall. ROIC then, above 10% is what I aim for personally in my own investments. What we can see over the last 10 years, in fact, it has been struggling to be consistently around that level, but the last few years we do see it around 8 to 10%, which is okay in my opinion. Nothing great. I would like to see this push consistently above 10% for at least a good few years. Both operating margin and free cash flow margin roughly straddling around the 16 and 7% we aim for consumer staples. So not bad, but there isn't too much room for movement. So if they do have a bad year, it will come significantly below that. So something just to bear in mind. And now the net debt to EBITDA, which correlates to that dividend safety. What this translates to is the number of years it would take the company to pay off all of their debt net of cash on hand. We want to see 4 or lower, and we do see that for the majority of the last 10 years, and in fact it does start to come down, with 23 at 1.95, 24 expected to be roughly the same. Now we've gone through the metrics for SJM. Now what we can look at is that stock valuation. As always, if you enjoy the content, value is being provided. Do hit that like button, do hit the subscribe and bell button so you are continually notified of these videos as they drop. And finally, if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. Now, typically the first model we use is Graham's valuation, but unfortunately they have had earnings per share trailing 12 months of negative, so therefore this model won't be relevant. But what we would have done if it had a positive with the stock ticker symbol, the growth rate per analyst estimates, and that current yield on AAA corporate bonds, we would have then got our intrinsic value. Now this then applies to the multiples valuation model where we have companies in a similar sector and size. We'd get their average PE and then multiply that by the earnings per share. But again, because it is negative, it isn't one that's relevant. So we're using two models to value SJM. We have the first one, the dividend discount model with the yearly dividends, as we can see. Average growth rate, we've pretty much gone in line with the average growth rate of 4.55. But as always, if you do want to go for a higher percentage or lower depending on your optimism or pessimism, grab a copy of the model and play around with the numbers. This gives a DDM price of $127. Now, that is some very nice upside to the current trading price, but it is within that 52-week range, so it is showing some signs of undervaluation in the current market. We then move on to the second model and the final one we're using for SJM, the discounted cash flow model where we have our free cash flows year on year. Average growth rate at 12%, forward-looking 8% is what analysts are estimating in conjunction with our discount rate. We get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to give a DCF price of $155. Some very nice upside to the current trading price, but slightly lower than the 52-week high, again showing some nice signs of undervaluation in the current market. Now, as always, intrinsic value is just the average of the models that we've used and run through. Today's episode is just the DCF model and the DDM. And as always, if you enjoy the content, values being provided, smash the like button. It really helps this channel grow, pushes out the content to tons of other investors who do need this content. And if you do want to essentially have these videos drop to your doorstep, then do click on that pinned comment and do click on that bell button where these videos will be delivered directly to your inbox. Margin of safety, we always start off with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. If we move then to 15%, it's still showing a buy up to $120. At 20%, a buy up to $112. And at 25%, roughly lower. So I would say right now you are locking in between a 20 to 25% margin of safety. Now, what did Wall Street say? Well, over the next 12 months, they also believe there to be some very nice upside to the current trading price at nearly $30 per share on top. But as always, do let me know your thoughts in the comments below. Is SJ one that was even on your radar before? Is it one that's now in your watch list? Or is there a reason why this one isn't something you want to add to your portfolio? Finally, if you want to grab a copy of the intrinsic value calculator to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. And finally, if you enjoy the content, values being provided, smash the like button, hit the subscribe and bell button, and I will see you all on the next episode. Have a lovely day and take care.